Forbes has recently released an article where they believe that 8 stocks are undervalued, and there's one stock on that list that I want to dissect. And so that's what I'm going to do in this video. And so guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now this is part 2 of me covering the 8 stocks that Forbes thinks are undervalued, and here's the article. And I always have fun with these because I always like to look at the securities that they point out and see if I agree with them or not. And I'm not saying they're right or wrong, I'm just providing my own opinion. And as you guys may recall in the first video, they actually did provide their methodology, and essentially what they're doing is they're looking for companies with strong competitive advantages that are trading under a PE ratio of 20 times earnings. And what I said in the first video, or part 1, was that screening for PE will include low PE companies that have high amounts of debt. And that's exactly what I found and what I want to cover in this video. So here are the 8 names that they have. They have Berkshire Hathaway, Taiwan Semi. So Berkshire, in the last video, I told you guys that, you know, it's not actually trading at 10 times earnings. It's trading closer to 20 times earnings. So, I mean, I don't know if it's as cheap as they think it is. Taiwan Semi, you know, I let you guys know that it's very hard for me to predict what's happening in the chip space. And so, I just will stay away from this one. Although I did own it in the past, I just admitted to myself that it's probably a mistake that somebody with my aptitude towards the chip space, it just wouldn't make sense for me to own it because I just don't understand the industry. And it was, you know, it's unfortunate because I did see that the chip stocks were somewhat cheap in near the end of 2022. However, you know, had I invested in the chip names, especially Nvidia, you know, which ran up a ton, it wouldn't, even though I would have made money on that, that would have been a mistake because I just don't understand the industry. And so I'm glad that I removed these from the tracker. Tencent, Alibaba, and JD.com, you guys already know the China trade, and so I don't have to speak anymore about that with you guys. Wells Fargo, I do have to do research on this and add it to the tracker. British American Tobacco, I will add this to the tracker, but I'll add it to the dividend side. And so this one was the interesting one. Harley Davidson. I've never actually done any work on Harley Davidson, and the reason for which is because I do like motorcycles. Harley Davidson just has a reputation of just a low quality motorcycle, but it has a strong reputation. It has a real culture behind it. And so I wanted to dive a little bit further into Harley Davidson in this video. So first I wanted to start with why they like it. So they're essentially saying that the company has a PE ratio of 6.9 times earnings. And, you know, of course, if you guys aren't familiar with Harley, they make and sell motorcycles in the US and around the world. They definitely have distribution or stores here in Canada, that's for sure as well. They have a huge market share with an estimated 21%. And of course, you guys know what the culture is with Harley Davidson's. It's probably one of maybe 2 or 3 brands, like exclusive motorcycle brands that I can think of, right? There's other brands that, you know, make other types of vehicles as well. For example, you know, I think the more popular one would be like a Honda or a BMW, where they do make motorcycles, but they are also auto manufacturers, where Harley, you don't see Harley cars. So that's what I mean. Like, I think there's Harley, then there's Indian motorcycles, etc. And so the first thing that I wanted to do is I wanted to look at the consensus EPS estimates for the company just to make sure that the price to earnings made sense, right? Because they use trailing and I want to use forward. And so you can see you got 13 analysts covering the name. People are expecting that the company will earn around $4.35 per share in 2024. That reflects an approximate 12.7% equity yield because it reflects a forward PE ratio of 7.86 times earnings, or approximately 8 times earnings. So just 1 divided by the 7.86 gives you your equity yield. So overall, that doesn't seem too bad. It seems relatively cheap. The question is, how sustainable are these earnings? Is this a high earning point? Like, is this just what we expect for 2024? And do the earnings come down? Like, why is the stock price so low? And I guess one of the things that you're seeing is that as goes with many types of discretionary purchases right now, you're seeing a decline in sales. And so the question could be that 2025 and beyond sales may potentially continue to drop off. I'm not really sure, or at least when I was doing the research at this point, I wasn't really sure of what that would look like. And so, you know, definitely the consensus estimates do reflect a decline in sales, which we have seen year to date in Q3 and probably expect them to continue in Q4. However, Notice how the company speaks to this in their slides. So right beside it, what they're saying is that pre-pandemic, so Q3 2019, the average dealer units were around 60,000 units. And right now it looks like there still continues to be a dealer inventory build. I would say that just because you have 48,000 units at the dealer inventory doesn't necessarily mean that the dealer inventory units will continue to increase, especially in an environment where interest rates are higher. Harleys are generally more expensive. People do finance them. And so higher rates probably would result with fewer people purchasing Harleys. And so, maybe this 60,000 units might be too high. Maybe the 48,000 might also be too high. So I understand what they're trying to say here, but I don't necessarily agree with it. Although I'm not, completely disagreeing with it. I'm just saying the environment is different. It's I think a lot of companies try to do the pre-pandemic, post-pandemic comparison, but the environment, the industry, the economy is different now. And so we also have to take that into consideration. Interest rates are higher. That's something to really pay attention to, especially for a discretionary purchase, which people use financing to make. And so what I did was I thought it'd be cool to model out Harley Davidson. And so I built the model out. It's available in the tracker for you guys. So anybody who does have access to the tracker, you can get access to this model. Now notice that they have 3 segments. They have the motorcycle segment, the financial services segment, and the live wire segment. And what I want to focus in on is a lot of people wouldn't like if you were to ask somebody and say, hey, where does Harley Davidson make most of their money? Of course, they're going to say with motorcycle sales. You got, I would say in 2023, you got $5 billion of revenue, whereas the financial services segment only has $636,000 of revenue. And then, of course, the live wire is essentially immaterial. But the one thing I want to point your attention towards is notice the operating income. It's 684 compared to 246. So that is a material amount of operating income that they're generating from the financial services segment. The margin of operating income to revenue is almost 40%, whereas you're dealing with 14% here. So you have to pay attention to the financial services segment. And here's where I get a little bit more concerned. I didn't forecast any growth out for it. Also didn't forecast any material growth out for the motorcycle segment. But here's where I believe that they can run into an issue with, higher interest rates in the current environment, which would slow down the sales growth for the motorcycle revenue segment. In fact, I almost think that this could potentially go backwards, despite the fact that Harley Davidson is trying to tell a story where the motorcycle segment could actually go the other way, like grow, because dealer inventories need to increase. And that takes us to the balance sheet. And the thing that I want to point out here is at the end of 2022, I should probably be showing you the end of end of Q3 2023, but just focusing on here for a second. For at the end of 2022, they have $1.4 billion of cash on hand. They have $2.4 billion of short-term debt and $4.4 billion of long-term debt. So $7 billion of debt. Also keep in mind that I also look at working cap and notice they just have a large amount of AR. They got $2 billion of AR here, and they have an immaterial amount of AP. So technically, if you really wanted to, if you're calculating excess capital almost, you might want to add the AR to the cash amount before you subtract the debt. You could do that. I didn't do that, but I can show you it pre and post in this video. But the real crux of it and the point of showing you the balance sheet is notice how much debt they have. So this is what I was talking about, how when you screen for low PEs, you got to be careful because you might run into companies that have a ton of debt, which may potentially justify why their stock prices are so low. So you got $7 billion of debt. What does that really mean to the valuation? And so here's the valuation. And I guess, we're all going to have different valuations here. So I'm not saying that this is the be all end all, but what I am saying is that I think many of us will come to the same conclusion that this might not be an undervalued security. And here's why. I'm valuing the company at around $50 per share, which is definitely higher than the $34 per share that is trading at today. It doesn't give you that 50% margin of safety, which is fine. But when you include the excess cash, which is, effectively just the short-term and long-term debt less the cash on the balance sheet, so it's the net debt, per share, you're looking at $37 per share. And so, of course, that values the company at around $13. But remember, guys, I said that they have the $2 billion of AR. So imagine you just wipe off half of this or even more than half. So you say that it's instead of $50 per share, let's just, for argument's sake, let's just say that it brings it down, that AR brings us down to $20 per share of net debt. So you have a $30 per share valuation, and the company's currently trading at $34 per share. So it would still be overvalued, at least in my opinion, in that situation. And so that's where I think that you run into a problem with this type of screening. And so I think when you do screen for PE, you should also screen for debt at the same time, or just screen for PE, but just be aware of the debt. So for this reason, I'm going to stay away from Harley Davidson, but some of you guys may look at it differently. And so I'd love for you guys to let me know in the comments if this is a position that you guys may consider taking on. And, one of the reasons why you might want to take this position on is, hey, what happens if Harley has come out, and I haven't dug in this deep yet. This is still a superficial analysis, so to speak. I mean, I did build the model, but it's still at the superficial level, I'd say. But one of the things that I would want to dig into is, if you were considering this position, is when does that debt mature? If the debt is maturing 20 years from now, should you be discounting that debt? And so is the excess capital really should it be really shown at the present value of that debt? So that is something to look into if you guys are interested. And you know what? There might be value if you do that. And I showed you guys this last time in part 1, but there's a ton of names hidden under this pink, and of course I'm showing you Alibaba and Tencent, that are trading, in my opinion, at a share price relative to their intrinsic value, which seems somewhat more reasonable. Some of them I do hold in my portfolio. None of this is a recommendation for you to buy or sell securities, but what you can really do when you get access to this tracker is you can click into each one of these models, and it'll take you to a full blown out model, similar to what you saw with the Harley Davidson model that I just showed you. And how do you get access to this? Well, you can get access to all of my research at the low $5 a month tier, but if you want to join us for an epic live presentation every month, you can join us at this higher tier where you get access to the live monthly calls. They are recorded. There's special live courses and a comp schedule. And so there's a lot of value here at this higher tier. And of course, there's a third tier coming out soon, which will essentially be walking through the modeling of companies with you guys. And that will be limited to a certain amount of people. I think I'm going to just limit it to around 20 or 25 people. And so the first 20 or 25 people, that'll be it. I'm not going to open it up any further. And so let me know what you think about that list overall. Let me know what you think about Harley Davidson. Have I missed something? Like I said, I did somewhat of a superficial analysis. I've included it in the tracker, but let me know what you guys think as you dig further into this. Is there a value here? I'll leave it there, and I'll see you guys later.